make so much money in forex trading. The moment we start getting them so complicated, then we begin to lose track of what we should pay attention to. So, in the course of this class, we'll be learning about the conventional way of trading in terms of price action. There are different approaches that we make anytime we're trying to make a trading decision, depending on individuals. Now, there are traders who are comfortable with the indicator approach. Some are comfortable with pure price action, and then some trades in a hybrid way in such a way that they combine price action together with indicator. I hope you're following. And then away from that, there are two ways to analyze the market, or probably three ways. Number one is the technical analysis. The technical analysis has a lot to do with the you're looking at the trend, you're looking at direction, pure price action, support and resistance, demand and supply. So that is the technical way of approaching trading. And then there is this other approach called the fundamental. So it means you are trying to read the news, you are trying to look at the non-farm payroll, you are trying to look at the CPI. Probably let me just put it on for you so that you can see what I'm talking about. For it's for 3K. So, okay, so most of the fundamental traders, this is what they look out for in markets. So they try to engage news. Look at all of these. See, this is Sunday, this is Monday. Okay, let me just put this on. Let me filter this out and then so that we can have only the high impact news. Apply filter. Okay, so as you can see, this is USD, this ISM manufacturing PMM, this employment change for NZD, that is New Zealand dollar, and then this is for unemployment rate. So there are individuals, there are a group of traders or particular type of traders that what they really focus on, just trying to understand the fundamental, the news aspect of trading. If you understand the news aspect of trading, you are going to make money. If you understand only the technical aspect of trading, you are still going to make money. But if you can blend both the technicals and the fundamentals together, you are going to make a whole lot of money. And away from technicals and fundamentals, there is also another aspect called the sentiment. Called Forex sentiment. Forex sentiment is just a way of trying to look at the market by seeing what people or traders are doing in the market. Now, for instance, this is Euro USD. And then once you come to this website, you click on Euro USD, look at the symbol, you can see the percentage of traders that are selling and the percentage of traders that are buying this particular assets, right? So you see that 56% are selling, 44% are buying. So as a sentimental trader, you always want to look at the direction of the market from what a lot of persons are doing in the market, right? So as a sentimental trader, probably you just focus on, you come to this website and see, oh, Euro USD today, people are, a lot of persons or a lot of individuals are buying, or a lot of, for USD JPY, see about 66% of traders are what's taking long positions. Long position, they are taking buys, right? Okay, so look at Euro AUD. About 77% of traders are buying Euro AUD. So you see, there are traders that approach the market through this kind of analysis or through this source of information. But today, for us, we want to look at pure price action, right? So, and that's what I'll be teaching you today to see how you can use pure price action to understand the move of the market and how you can start taking advantage of them. The last class, I think you joined late, or probably maybe you didn't join, because I think I sent the link to customer care immediately after that first class. The following day, they have started sending screenshot of how much they were making, real money, because it's something straightforward and then easy to understand. So in the course of this class, please, if there's anything you don't understand, just call my attention without hesitation. Just make sure that you call my attention immediately so that we can address them um immediately. Okay, so now let's look at, okay, let me look at, see. Aha, so now this is what I want to show you. I want you to look at now. When you see something, there's what we call, let me just represent this with this tool. I hope you are still with me.
Yes, sir. I'm with you, sir.
Okay. So look at this. I just want you to pay attention to what we are seeing here. Ah, good. So from what you are seeing here, please, by the time you look at this critically and very close, you will see that this looks like an A shape, right? This looks like an A shape, right? This looks
Yes.
like an A shape. Yes. And then
Yes,
looking
sir.
at this, this looks like a V shape. So in the market, anytime we see an A shape like this, we mark the high and we call it what? We call it our what? Resistance. We call it our what? Resistance. So it means A level is for what? Resistance. Okay, let me just take out this so that we can have a proper label. Okay, look at this from here. Uh-huh. So we call this what? Resistance A level, because it looks like alphabet. Hey, you see, this is resistance and A level. So anytime you open your chart and you see something like this, it is what? This is your resistance and this is your A level. We call it resistance A level. And what do we do at resistance A level? We look for what? We look for sales opportunities. We look for what? Sales. We look for sales opportunity. We look for sales opportunity. So for A level resistance, what are we doing? We are selling. We are looking for sales opportunity. And then the opposite of A level is what we call the V, is what we call the V level. And in this case, the V level that you're seeing here, we call it what? Support. We call it support, which is what? The V level. And from the V level, what are we doing? We are looking for what? Buys. We are looking for what? We are looking for buys. So it means A level resistance for sales, V level support, V level support for what? For buys. V level for what? For buys. A level for buy. So before we move on now, please, I really want to hear your feedback. Do you understand up to this level?
Yes, I do, sir.
Okay. It means we can move forward and go ahead. Now, so how do we trade support level and how do we trade resistance level? And you know our resistance is the A level and the support is the V level. So how do we trade this? How do we trade this in the market, right? So this is what I will be showing you. Because that you have the understanding of what A level is and the V level resistance is, does not mean that you start taking all the A's and the V levels blindly in the market, right? So let me show you how to do this effectively and then profitably in the market. Okay, so let's move on now. Okay, so if you want to trade an A level, which is for resistance, you want two things to happen. You want to have this, and then you are selling from here down. So selling what from here? So this now becomes our sell zone because these are A level. So this is where you'll be looking for sales opportunity. Why? Number one, before we can take sales from this so we call it our what? We call this our A level, right?
Uh,
Because, huh?
Resistance.
Can you hear me?
I said resistance.
Yes, our resistance, good. And then before we can sell from there, these are A level. We're looking for sell POI. Sell POI. We call POI point of interest. It's still the same thing as your resistance level, your A level, where you want to take trade from. But before you can take any trade from this A level, you must ensure there is what a break of structure. Did you see that price broke through this last low, right? You see here.
Yeah.
So you make sure that there is what at least it can be two or three, but you want to ensure that there is at least one break of structure. Nothing less than a break of structure. It can be more, but at least one break of structure. Make sure that there is what? A break of structure. So once you have a break of structure, it means your A level is what? Valid. Now, it means your result is valid, but what if you have something like this? You have something like this, price now came down and didn't break that low, no break of structure, and price went up. Will you still take this one? No,
No.
because what? There is no, this is a resistance. Yes, fine, there is a resistance, but there is no what? Break of structure.
Stop.
There is no break of structure, so we are not going to take this particular one. Okay, so the same thing goes with um trading your V, which is your support level 2. So you have something like this. There must be a break of structure to the upside before you can consider this V, your support, as your what? As your POI, your point of what? The point of interest. This is where you want to look out for buys from your POI. That's where you want to look for your buys from. Yeah. So because you have already here, you have a break of structure. So it means for your V level, there must be a break of structure to the upside, BOS to the upside. Yes, before your V level can be valid, which is this. And then for your A level for sales, you must have a break streak to the downside. So you want to see a break of the downside, and then price retrace, go back to your POI, and then you want to take sales opportunity. Take sales, you want to take your sell position here, and then your stop loss a few pips above the previous high, and then your low, probably somewhere here 6R, but we can keep it as what 3R. Please, do you understand what 1R, 2R, or 3R is? Are you with
So I
me?
didn't get it. One eye.
Huh?
Yeah, with you. You said one what?
Oh, your voice is breaking now. Can you have a stable network?
Okay, let me disconnect from this. It's my Bluetooth.
Okay, please. I need a more because I really want you to. I really want to ensure that you're following through.
Can you hear me now?
Yes, it's a bit better now. So what I was saying is that do you understand the concept of 1R, 2R, 3R, all this risk to reward ratio?
No, I don't.
Okay. So so please look at this clearly. Look at what I do. But do you understand this thing I did? The stop. Do you know what stop loss and take profit is?
Yeah.
Okay. Looking at this now, you can see that your stops is. You can see the stops here based on this structure. You are seeing stop. And when you look at the bottom with the green line, you are seeing target, right?
Yes.
Okay. And in the middle here, can you see something like risk to reward ratio there? Risk to reward ratio.
Risk to reward ratio.
Yes.
Yes.
Uh-huh. And that is what 3.09. So that is 3. So we call it 3. So what it means is that assuming you put $10 on this trade, what you are going to make from this trade is $30. Are you with me now?
Yes, sir.
Because the risk to reward ratio is 3.0. So if the risk to reward ratio, for instance, is 2.0, for example, if it is 2.0, it means on this particular trade, if you put $10, how much profit do you think you are going to make if this trade goes your direction with 2.0 risk to reward ratio?
That's $20.
Exactly. So that is just the concept of this. And then for this that we are trading now, if price is coming from this sell zone, we want to put our TP at what? At the last structural low. So we call this last one here, we call it our what? Structural low. So that's where you want to put your what? Your take profit. And the RR here is what? 6.0 or 6.7. Let's just put it at 6.0. So it means if this trade does well and you put a $10 uh on this trade, it means you're going to make $60. Does it make sense?
Yes, sir.
Okay, good. So we're going to be taking this step by step. Mhm. So, um, so that is how to do this. And then for buy also, you place your buy limit or you enter instantly and you take the profits at the highest stop with a few pips below here. So that is how we do it. And then one thing you should also note is that if you are taking this particular trade, of course, the first rule one, let me let me tell you your rules of engagement. You can screenshot this or put this down, rules of engagement, because if you do not follow these rules, this thing might not really work the way you expected it to work for you. rules of engagement. So you'll be having your rules of engagement here. I'll be giving us, okay, I'll help you with those rules. Number one is that there, from what we have seen, there must be a what? A break of structure, right?
Yes.
There will be at least a break. You know what? Let me just put BOS to minimize space. At least there must be a word. So I'm not saying that you cannot have multiple breaks. You can have one break, two break, three breaks, fine. But in this case, there must be at least a break of structure. So what this tells you is that if you can't find a break of structure, it's not something that you should even bother looking at all. Don't look at it at all if you can't find a break of structure, because the possibility of it failing is very, very high. And since we are putting our hard-earned money, we would not want to put our trade on things that will not really profit, that will not really profit us. Okay, so can we move forward?
Yeah, we can.
Okay, good. Rule number two. Rule number two, your A and V. So you know what the A and V level is now, right? Are you with me? Hello. Are you on?
Which is, sir?
Okay, I said, you know what your A and your V levels are now, right?
Yes, I know.
Okay, your A and your V levels, rule number two now. Your A and your V levels must be fresh. Must be fresh. What I mean is that it must be unmitigated, fresh. On so your A and V levels must be fresh. It means it must be unmitigated. I will show you what it means in the chart. Unmitigated. Okay, so let me show this. So what it means is that you have your resistance level now. If before you can consider this resistance level valid, it means price must touch it only once. That is where you can use it. For instance, now, in this case, if price has touched this guy now and it's sold, by the time it's coming back here, by the time it's coming back to the upside again, the rule says that don't use it again because it has been used once. Do you understand what it means now?
No, I don't really get what you
Okay,
mean.
what it means that if you are selling from a resistance level and prices are sold from that resistance level, don't make any attempt to sell from a resistance level that price has already sold from before.
Okay, okay.
So since price has used it once, don't make any attempt to use it again. Do you understand the logic now?
So that means it's either it goes higher or lower than the other
So
distance.
what if, even if it goes lower, in as much price has already touched it once, it has been used, don't use it again. Look for a fresh one that price has not touched at all.
Okay.
Yes. So that is the rule number two. That is for rule number 2. And the rule number 3, this is the one of the most interesting parts, which we have not shown. Rule number 3 is there must be an inducement. Now, this concept of inducement, I think, is something that you really need to now look at now. So I want you to pay attention, but you understand the first rule. Our rules of engagement is that there must be at least a BOS. Your A and V levels must be fresh, unmitigated. And number 3, there must be an inducement. So this should be your checklist before you make any attempt to even look at taking any trades at all. This must be your checklist. This must be your checklist, okay? So let us just move forward. The reason why I'm saying this over and over again, because before this thing can work, if it can work, but before it can work effectively, please ensure that all of these things are in place. Because from today, I will want you to start checking the market and then seeing how you can start taking advantage of what I am teaching you today. Now that's why I'm taking my time to go over and over. If there's anything you don't understand at any point in time, please do ensure that you ask me questions, please, so that we can proceed with the speed of light. Now, okay, so the first one, you understand the first rule. There must be at least a break of structure. And now look at the break of structure here. That's the first rule. Number 2, your A and your V levels must be fresh, unmitigated. This is your V level here, which is your support. We are looking for buy. So it means price has not touched this origin. Price has not touched this PO high at all. Number 2, rule has been met. And then number 3, there must be an inducement. Now, how does an inducement look like in the market? That is what I'll be showing you now. Please pay attention to this. This is what an inducement looks like in the market. Okay, so let me so that you understand it better. Now, okay, so let me just use a fresh sure. So number 1, we have these V levels. Okay, we have number 2, a break of structure. So an inducement, you see price reaching out to your PO high, and then price make an attempt to enter your PO and then reverses back. Okay, what is wrong with my drawing tool? Let me just, okay. Something is wrong with my drawing tool. Let me take this out. Okay, still again, we have your V level has been created. Okay, you have your V level created, a break of structure to the upside. Obviously, trying to, okay, so you have this V level created, break of structure to the upside, and then you see that you want to buy from this V level, right? But you see that price will make an attempt to come to the V level, but all of a sudden, it will go what? It will go up a bit and then come back again. This is when you can now take your trade and what enter the buy trade. So now let us look at it. Now I want you to take a picture of this or just keep it somewhere or draw it on your notebook or somewhere so that you understand the semantic and exactly how you should approach this in the market. Now you have your rule number 1, which is your what? Which is your BOS. Okay. You have your rule number 1, which is your BOS. Your rule number 2, you have a fresh V level here. A fresh V level. You have a fresh V level here. Fine. So that means rule number 2. And then rule number 3, there must be an inducement. So what you see here is what's an inducement. I will see explain to you again. So this your inducement. You can label it as X, or you can label it as IND is inducement, but because of the space might not contain all of this. So that's why I want to label it as X, your inducement. So you have your inducement here as what's X. So what it looks like is that you have your break of structure, you have your V level, and price made an attempt to go back to your V level where you want to place your buy positions from. For instance, you want to buy from here. Eh? Yes, this is where you want to buy from. This is where you want to buy from. Okay. So you want to buy from here, your V level here. You want to buy from your V level here, for instance. Now you are waiting for price to touch this your V level as a fresh zone that has not been mitigated at all. Now you will now see price making an attempt to touch this your V level, but price did not touch it and we went back. So what this creates in the market is that it creates liquidity, number 1. Number 2, it makes you feel like you have missed out of that trade completely, because at that point you now feel like price is buying without you. You jump on it, and before you knew it, price will now come down again, and then it's now take you out. You now feel like, wow, oh, what's happening? And before you know it, price takes you out and they start going in your what? In your direction. So there must be a break of structure, there must be an inducement, and you have an unmitigated V level, and then you take your buy entry. Now, it looks like story because the same thing applicable to your sales trade too. The sales trade is just like an opposite. I want you to take a screenshot of this so that you can put this into perspective anytime you want to take your trade, so that if it does not look like it, you run away from it. So this is now going to be your what? Your fresh level. This is your A level where you are going to be taking your sales position from. Okay, now you're going to be taking your sales position from, and then this stop loss. This, okay, you can put your stop loss around there. Okay, for me, I just love 3R, but sometimes by the reason of strength, based on structure, you can decide to take it further. And then let us just label this appropriately. You have this as your what? As your inducement. I said that this is your inducement level. You can also mark it as what? As X. Now look at this. Now we have our rules, all the 3 rules of engagement in place. Now the first rule is that, okay, there must be a break of structure, which is this, a break of structure to the what? To the downside. You have your BOS, break of structure, BOS to the downside. Yes. So you have your BOS to the downside, number 1 rule. So if you have 2 rules checked from our rules of engagement, it is not a good trade to take. It is a B, there's what we call B trade, a secondary trade, right? But if all these rules, the first one, the second one, and the third one are in place, what it means is that you have an A setups. And then on this particular trade, it means that you can actually risk big or risk much on this particular trade, right? You can risk big, risk much on this particular trade. So you have your break of structure, you have an inducement. So that I tell you that inducement levels, these are areas of values where price will make an attempt to get to your POI. In this case, your A level, your sell. You are waiting for price to sell here, but price made an attempt to get there. Price didn't get there, came down a bit, and then returned back to your POI. This is when you should sell. So until you see this formation in the markets, don't take any trade, right?